joining us for this deep dive. Today we are going to be talking all about CDFIs, Community Development Financial Institutions. It's a long acronym, but it is a powerful tool. And we have some great folks here today who are either existing CDFIs or are becoming CDFIs, and they want to share what resources they can bring to the table. So today we have with us Maureen Milligan, hopefully who will be joining us soon, from the National Development Council, Laura Husky from the Midwest Housing Development Fund, who is also a member of the Spark Developer Academy Advisory Group. And then we have two folks from Spark Capital, which is the lending arm of Spark. And that's Jamie Berglund, our executive director, and Lee Alexander, our real estate finance director. We also have on the call another CDFI executive director, Jim Rafe, is with us. He's also on the advisory group. He's going to be presenting information about his organization at the next deep dive. So I did want to plug the remaining deep dives we have for the summer schedule. We're going to be doing that business planning 101 and learning about the resources at the Nebraska Enterprise Fund and the Nebraska Business Development Center on the 23rd. That may seem like it's not development related, but all of you are small business owners, and that's a key part of any information you're going to be giving to a bank or lender as you go about doing your projects. So I highly recommend that you come and check out these resources that are available to you. On the 20th, we'll be taking a small break so that Spark staff can take vacation. And you can too, hopefully, in the month of July, but we'll be back on the 28th with a session with our friends from Olson Engineering as they go over the due diligence process. On the 11th, we'll be meeting in person, yay, for a session about city funding and finance opportunities. Bridget Hadley and Pat Evans are going to go over all things from CDBG to TIF to the home program and other acronyms that we'll all learn together about. On the 25th, we're going to be talking about missing middle housing. There's kind of a cool grassroots movement that's pushing advocacy and legislation to support housing developments like duplexes and fourplexes and accessory dwelling units here within the city of Omaha. So we'll be talking to Will Green then. On the 8th, we're going to be talking about another lending resource through the Middle Income Workforce Housing Fund. Hopefully we'll find out soon that 7 or 8 local organizations are being funded by the Nebraska Department of Economic Development to bring more housing in build more housing in qualified census tracts. So we'll learn about those funds and how they might be accessible to you and your projects. And then we'll round out the last session before the second cohort of the year for the Developer Academy with a session on the 22nd about housing affordability. What is affordable housing? How do we define it locally? Where do we see it? And what resources do we have to build it? We will then have a hiatus while we operate the second Developer Academy session of the year. We are firming up the details on that, but it is looking like we'll be meeting middle of October. So if that is a course that is of interest to you, contact me and I can give you a few more details, or just for now, book out the weeks of October 11th through the 25th on your calendar as we make plans of meeting in person this time and what that course is going to look like.
Can you say the dates again? I'm sorry.
Sure. I think it's the 11th. Sorry, I don't have my calendar up in front of me. Is that a Monday? Yep, October 11th through the 22nd. Those 2 weeks. All right, so I just want to give a shout out to our program partners and sponsors. This educational series and the Developer Academy would not be possible without their support. So thank you to NDC for all of the support to help launch this program, and Freddie Mac as well. We also have some local banks that have supported us, Wells Fargo and US Bank. And then we have a lot of local sponsors who help provide things like scholarships to make this affordable for everyone. Field Day Development, Olson, Baird Holm, CIT Bank, Great Western Bank, Bluestone, Dundee Bank, Foundations Development, Lamper Nearson, and Earhart Griffin and Associates. We are continually blown away by the development community's support for this program, both in financial support and also in those amazing connections that they are providing to the developers who go through our academy. Their time and talent is greatly appreciated. All right, I'm gonna stop my screen share. Is Maureen on the call? Hi. All right, Maureen, you are up first. This is Maureen Milligan, and she is a friend of ours from the National Development Council. And she's going to give us, to start off this session, an overview of what CDFIs are. All right, take it away, Maureen.
Sure, no problem. Good morning. And I want to congratulate all of you for surviving Corey Leon and all of his dad jokes. So I don't know, I may be insulting dads by calling them dad jokes. So we're just going to call them Corey jokes. And congratulations. I listened in on many of the sessions, and I know Jamie and Angela had to reel them back in sometimes. So congratulations on getting through all of that. Really tough, but really necessary material. So I am going to share my screen. And we will get started. I just have a few slides so that we can walk over community development financial institutions. All right, are we seeing the slideshow? Awesome, okay. So I'm going to just read the definition from the OCC about what community development financial institutions are, and then we're going to walk through the different forms that they may take, a little bit of the history of the development of CDFIs, how they get their funding, and then sample projects that you often would see CDFIs engage in. So CDFIs are mission-driven financial institutions that create economic opportunity for individuals and small businesses, quality affordable housing, and essential community services in the United States. And later on in the slides, we'll talk about the development of the CDFI fund, but the CDFI fund is both an certification organization as well as an organization that provides a great amount of funding to CDFIs that get certified through the CDFI fund. So to be able to get certified through the CDFI fund, you have to demonstrate that you meet certain criteria to be a certified CDFI. And if we think about a lot of community development organizations, especially if you've talked already about CHODOs, community housing development organizations, you'll see that a lot of the criteria are very, very similar. So first of all, you have to be mission-oriented and mission-oriented regarding community development. And since you're a CDFI, you need to have a financing component. So your primary activity that you're going to engage in is going to be financing. We'll talk a little bit about how technical assistance and other business support is certainly part of the mission also, but the financing part is extremely important for you to be a CDFI. Much like a community housing development organization or a community development corporation, you need to have at least one or more target markets. And the thought is CDFIs, one of the reasons that they are supported by the federal government is because they're organizations that are thought to really know a community, represent a community, be led by members of a community. And so they can really help address some of the community development needs. And so that's why when an organization is applying for certification from the CDFI fund, they have to define their target market. It can be as small as a neighborhood, it can be nationwide, but you have to demonstrate, as you'll see, that you're also going to be responsive to whatever target market you define. you also do need to provide additional services. So you'll see that banks can be CDFIs, but the thought is the added value that a CDFI really provides is that close one-on-one assistance with borrowers or people who are receiving services, other services from the CDFI. So you have to provide some kind of development services as part of your financing activities. And then you have to maintain accountability to your target market. So how are you engaging in community outreach? Who is on your board of directors? How are you ensuring that there is a close relationship, and not just a relationship, but accountability to the community that you're serving? And then governments can't form CDFIs, so you have to be a non-governmental entity. So the origins of CDFIs are both interesting and very sad. I'd encourage you, if you have not read the book, The Color of Money, Black Banks and the Racial Wealth Gap. Have it right here because I was using this to form the timeline. It's academic. It's not necessarily a Saturday afternoon reading or Sunday, reading with a mimosa, but it is incredibly interesting reading, and especially as you are moving forward in your careers, developing in Omaha and beyond, understanding how capital flows into communities or doesn't flow into communities is very, very important. And I know it was discussed in some of the earlier sessions with Corey and may have already been discussed in some of your deep dives. But if we look really right after the Civil War period, actually during the Civil War, when Black soldiers were paid wages, there were savings accounts that were created for the soldiers. Shortly after the war and after emancipation, there was a Freedmen's Bank that was created. And it was created with good intentions, being to help former slaves save money so that they could become homeowners, landowners. Unfortunately, the history of the Freedmen's Bank is extremely sad. It grew to be a very large depository institution. And for its early years, it made very, very cautious investments. But over time, as it became bigger, the board of directors of the bank really started squandering the money of the bank. And they began making very, very risky investments. They began self-dealing, making loans to friends and family, connected individuals. And so eventually the Freedmen's Bank failed. And thousands of families lost savings that they had put into the bank. And so this was where we really saw distrust start to grow between newly freed African-American slaves and banking institutions. And it took many, many years to start building that trust back. That started with then in 10 or 20 years later, Black-owned banks being formed and families starting to deposit money into banks again. In the 1930s, we started to see the development of credit unions. So as opposed to a bank where there isn't ownership, there isn't accountability within the local community, you started to see credit unions that were actually owned and managed by their members. And so that was another way that the banking industry started having a more of a connection and more leadership by community members. Jump to the 1960s, we had the war on poverty, and you can kind of think of some of those measures as more academic, led by the Kennedy and then the Johnson administration. And then when you had the civil rights movement that was grassroots, and those two movements converging led to the development of a lot of community-related organizations, including community development corporations, which again, we're looking at making comprehensive investments in communities and really cleaning up a lot of the mess of prior federal, state, and local decisions. In the 1970s, we saw very successful community development banks. One of the most famous is Shore Bank, that invested millions of dollars in Chicago with a focus on really comprehensively helping to revitalize neighborhoods in Chicago. And Shore Bank actually was the bank that inspired President Clinton in the 1990s when he helped shepherd through the Regal Community Development Act, which helped create the CDFI fund. So CDFIs had existed before the CDFI fund was created, but like many other organizations, they had difficulty raising capital for them to engage in the activities that they engaged in. So the creation of the CDFI fund really allowed for CDFIs to experience some explosive growth, both in the size of existing CDFIs as well as the number of CDFIs across the nation. So there are four main types of CDFIs, and I think it's important to focus on this because as you think about working in your community and seeking debt and equity, but also as you continue to be even more engaged and even be a leader in your community, that there may be opportunities for you to serve on boards and take other leadership roles related to CDFIs that exist or that could be created in Omaha. So as we talked about, for example, the Shore Bank example I gave you, we've got community development banks that are providing capital in distressed communities. And so they have a very community-centric focus. They take deposits and make loans. Very similarly, you've got community development credit unions also can take deposits and use those deposits to lend out for mortgages, other personal credit, development finance. But the distinction between credit unions and banks is that member ownership and that member's leadership. And then if we go to institutions that are still CDFIs but don't take deposits, right? So you don't have to be a bank to be a CDFI. You've got community development loan funds, which you'll get to hear more from Jamie about. And they're going to focus on that debt side primarily for community development activities. And then you've got venture capital funds, community development venture capital funds. That's going to be your source of equity for community development activities. So as I mentioned, until we had the creation of the CDFI fund, it was difficult for CDFIs to really grow and make large and make numerous loans because they first had to find a source of capital. So one of the ways that CDFIs have obtained the capital that they can use for their activities, their loans, as well as their technical assistance, is from banks and insurance companies. And banks have been primarily motivated by Community Reinvestment Act compliance. So to demonstrate that in the area where they take deposits, they are engaging in community reinvestment activities. And so investments in CDFIs can be a community reinvestment activity. And then really with insurance companies and other financial institutions like that, it's really to avoid at some point having CRA responsibilities. So they're trying to be good actors before they're seen as bad actors and additional regulations are imposed on them. But you'll have governments, religious organizations, foundations, and individuals that will also either invest in and assuming then some kind of a return on their investment or just make grants to a CDFI. And I'm sure Jamie may talk a little bit about where Spark raises its capital, but I bet it's from all over this list. So some examples of activities that you'll see CDFIs engage in, I think it's really interesting. It's all over the map. And what you'll see is that role that CDFIs play in the community is to make investments where it's seen that investments are too risky or too time consuming. For anybody who's worked for a bank, You know that banks thrive on uniformity and simplicity. And the loans and the activities that CDFIs are engaging in are unique and are often complex and are often time consuming. And so that's the role that CDFIs are playing in communities. So as you've talked through in your earlier classes, that pre-development period when you're looking at your project and really deciding go or no go is very, very risky because you may make the decision no go. But you're expending funds to do some of that due diligence. And so CDFIs can come in and make pre-development loans where otherwise a developer would not be able to get that funding to even engage in that activity to determine go or no go. And not only does that help the developer make good decisions about what projects to move forward with, but it can help other than lenders feel comfortable that some of the risk has been taken out of the equation. So it can help attract some of that permanent financing where a CDFI really makes that loan at the riskier part of the development process. Also small business loans, we certainly have learned over this past year and a half that there's a great disparity between minority-owned, women-owned businesses and the small business capital that they are able to raise. And so CDFIs can fill that gap and really help a lot of small businesses gain access to capital. And then third, the technical assistance is really, really important. And certainly as a small business lender at NDC, we do this. There are some borrowers that we will work with for 1, 2, 3 years before we actually ever make them a loan, because when they come into us, they just are not at the point where they would qualify for a SBA loan. But with our technical assistance, we get them there. We get their financial documents in order. We help them with some of their business operations so that they then can borrow. And in some ways, CDFIs can help really focus on different sectors that have trouble raising capital. So for example, the Reinvestment Fund in Philadelphia really has focused a lot on childcare providers and ensuring that they have access to capital. So that's another thing that a CDFI can do. And then one really, my background, I'm an attorney and I worked in the city of Dallas and helped with a lot of our payday lending legislation. And so I think one really interesting thing that CDFIs can engage in and that the CDFI fund actually has specific awards for are CDFIs that really try to play the role of being a small dollar lender in a community, so that rather than paying 400% interest in an emergency situation for a family, they can go to a CDFI and get a loan that may be higher interest than a traditional loan, but is certainly not at the 400 interest level. And then just the last slide, I just wanted to read this quote because I thought it was a very interesting way to view CDFIs. So it says, as financial intermediaries with community development missions, CDFIs tend to operate both in the worlds of wealth and poverty and the worlds of large organizations and small groups. And so I think it's really interesting, and certainly this is, I think, a great segue for Jamie, because Spark has done a fantastic job of this. The leaders of CDFIs need to be able to operate in those two worlds. They need to raise the capital. They need to really and raise up their mission to organizations that may not be community development focused, but they also need to deeply, deeply understand their communities and the needs and the products that really they should deliver for the communities. And those are different in every community and maybe different year by year. So that is your brief overview of CDFIs.
Thanks, Maureen.
Absolutely.
We are going to turn it over to Jamie now just to talk about what the CDFI landscape looks like nationally. And then we're going to hear from 2 local CDFIs so that we can understand what resources they bring. Take it away, Jamie.
Great. So I just wanted to do a nice little visual to recap some of the information that Maureen just shared. I loved learning a lot of that history. I feel like I knew a lot myself, but I always learned so much from you, Maureen, and I'm really excited to dig into that book to learn more. So this is just a nice visual to talk about these small and big organizations and the interface of a CDFI and the role of the community borrowers. So you've got your investors that could be any one of those groups that Maureen discussed. They're making investments in a CDFI to do the work, to provide the technical assistance, to do the mission-driven focused lending to the borrower, which could be, you know, for our purposes with the loan fund that we're building is very real estate focused. But as Maureen shared, there's also individuals that can borrow, small businesses that can borrow. And so here's just kind of an example though within the real estate space. And then what happens when that borrower repays, that comes back to the CDFI. Some of that interest and fee stays with the CDFI to help manage its operations and to fold into future loans. But then there's also interest and principal that goes back to those lenders. Many of those entities that are investing are making small interest or low interest loans into the fund, but do expect a repayment. So this is just a little example of that. So wanted to share kind of the landscape of who exists in our community. Two organizations that are not on this list because we're not CDFIs yet are Spark and then also Lending Link. So Maureen mentioned payday lending as a industry that has profited pretty heavily from those living in poverty. And as a way to combat that, locally legislation has been passed, but then also Lending Link came online a couple of years ago as a resource for providing small loans to individuals at a very affordable interest rate. And so they're in the process of applying for their CDFI certification, and we're crossing our fingers that they get that. One of their staff members, Daniel Padilla, is actually on our Spark Capital board, and Spark Capital also hopes to become a CDFI. We applied for a technical assistance award last year and we got it. We're applying for it again this year. And as soon as we start lending, which we hope we make our first loan yet this week, we'll be able to start that certification application in about a year. But just to give you a sense of who else is in this space locally, you're going to hear a lot from Laura Husky, who's up next. She is with the Midwest Housing Development Fund, which is an arm of the Midwest Housing Equity Group. And they have a service area that actually, I believe now even expands these areas that beyond Iowa, Nebraska, Kansas, and Oklahoma. I think they're in 10 states at this point, so I need to make that update. And then they provide services for affordable housing development, both loan products and development assistance. The Nebraska Enterprise Fund, which Angela shared, Jim is going to speak more at the next session around business planning, is a small business loan provider and also technical assistance provider. And then Omaha 100 is a CDFI for mortgages. So for home buyers that are needing assistance with maybe the first time they purchase a home, and then also home ownership services and educational programming to ensure that they have the knowledge and information they need to make that purchase. So that's kind of the landscape locally. And in other cities, you might find there's a larger pool of CDFIs, and our goal is to try to encourage more of that in our community too, so that we have some more of this capital available to support deals. So I will stop share and turn it over to Laura now, I think, who is going to move forward with an overview on Midwest Housing Development Fund and the resources and services they provide. Thanks,
just
Laura.
real quickly, thanks, Jamie. We did have one question in the chat. Someone was curious to know about ranges of the loan size, and I believe that will be covered in Laura's discussion and then Lee's discussion later. But if you do have any questions, feel free to drop them in the chat, and then there should be time at the end for us to have a conversation and make sure that all of your questions are answered. Thanks, Jamie. Sorry to interrupt you. All right, Laura.
Okay, good morning. I do have a few slides to show you just because it's easier with the visual. Can you see my, oh, no, not yet. There, now can you see my screen? Yes, we are Midwest Housing Development Fund. We are a nonprofit. Not all CDFIs are nonprofit, but many are. And we are an affiliate of Midwest Housing Equity Group, which is also a nonprofit organization here in Nebraska that was formed primarily because with low-income housing tax credit projects, you need investors that need those federal tax credits. And in those projects, 25 years ago, there were a lot of national investors, but our size of deals in Nebraska did not attract much equity from investors interested in tax credits. So the governor worked together with, actually Warren Buffett was one of the early investors, to start Midwest Housing Equity Group, which was actually Equity Fund of Nebraska. We then expanded to Iowa, Oklahoma, and Kansas, not necessarily in that order. And as Jamie mentioned, we now are in 10 states. And actually Midwest Housing Equity Group is in 16 states now. But where just a short who we are a CDFI, as mentioned. We're based here in Omaha. This is where many of us live and work, although we do have a lot of staff across our footprint now. And so we do have more time and staff time that we spend in providing technical assistance beyond the lending side in the Omaha area and in Nebraska. We were established in 2000 because in these deals, just like Maureen was talking about, it's high risk in the pre-development area for lenders. And we specialize in smaller rural projects, although we do now more in more urban areas of the Midwest, and also projects that are sponsored by nonprofit organizations. For example, we have in Omaha, we have a tax credit project that we partnered with Open Door Mission, just as an example. We did not necessarily have a lot of capital to put up front for pre-development expenses. MHDF would be there to provide a loan to the project for those expenses. So that was the precipitus for forming our organization. We now have 3 staff. Dave Fisher, our president, who was a former COO of the Federal Home Loan Bank of Topeka. And then before that was in Omaha in banking. Myself and Paula Ryan, who is now our loan administrator. And then we also have a contract with Midwest Housing Equity Group. And I mention all of this because the structures of CDFIs are going to, just our organizational structure is going to drive some of the type of loans and frankly, the risk tolerance that we have, which is part to your question, Tiba, as to what are those ranges in those loans. So you can see this is our core service area. We now are in additional states, which are 10. Now this is a really busy picture. I just wanted to show you this one little part down here. This is us. This is a low-income housing tax credit project, which is a complex financing mechanism. Most of the money to pay for the project is going to come from Midwest Housing Equity Group and purchasing those credits, usually 70% or so. During construction, that's usually going to be a bank lender. Typically during those construction of those deals, the banks can help out. Everybody's needing investors. So MEG has to seek investors for those credits. NIFA, in the case of Nebraska, Nebraska Investment Finance Authority, is awarding the tax credits. The IRS is overseeing NIFA and those credit awards. And we are here as a loan fund to provide anything from pre-development. We can do subordinated construction loans, what we call gap loans, which just really just means there's an opportunity and a way for us to be repaid, but it's not a traditional type of loan, or term loans. And we are now providing a lot more in term loans because we have become a member of the Federal Home Loan Bank of Topeka and can use some of that financing. But as Maureen mentioned, we have to find investors to fund those loans. So banks, philanthropy, and then we can access some dollars from the Department of Treasury's CDFI fund. Our organization is primarily using banks, bank investments, but that's because that's a lot of our relationships we already have with Midwest Housing Equity Group on the investor side. Some CDFIs do other fundraising, or they have philanthropy or those kind of things. And so I kind of wanted to talk a little bit about why you need us in the middle, right? That picture that Jamie is there, why isn't the bank providing the loan directly to the sponsor or developer? And there are banks that are CDFIs. So we don't have any in Nebraska, but they're not necessarily mutually exclusive terms. But banks have a lot of regulations and requirements in their lending about collateral and the risk that they're taking. And so it can tie their hands quite a bit. So even if you have a really good relationship with a banker, it might be difficult for them to be able to do, say, a pre-development loan that doesn't have collateral. And instead, if they lend to us, they're lending to us sort of kind of like a business loan. Like they're looking at our balance sheet, they're looking at what we're doing and our ability to repay that loan. And they're not so tied to the deal, so to speak. And so we are able to provide them with that reduction of risk, because in this business, a lot of risk sharing is what we do, and trying to make sure that everyone is comfortable in the deal. So that's a lot of times why we're in the middle. And we also provide technical assistance as our development services, as it's often referred to for CDFIs. And we have what's the Midwest Housing Resource Network. And we're just there to help developers, investors, communities, and sometimes it's banks. I just had a bank reach out to me and say, do you have any lenders that make this type of loan that could help us out in making those linkages? So this is a longer list, but really what it comes down to is being able to connect people with potential other opportunities if we aren't the correct lender. MHDF specifically, didn't need that last slide. This is who we are. I want you to have our contact information. We are willing to make loans in Nebraska that are what we call workforce housing loans on multifamily rental properties. We did do some experimenting in single family. It's just not where our knowledge is at and where we have the most to offer. So if you are looking at a multifamily property that's still affordable, and meaning the rents are affordable, not necessarily an income restricted project, and you're looking for things like pre-development, some gap financing, the construction side. We typically like to work with developers we already have relationships with in the tax credit program. But if someone else in the community reached out to us, what we would likely do is recommend a partnership of sorts, so that we know that one of our partners that is familiar with MHDF and our programs and the multifamily side is sort of there to provide some assistance to the developer on, putting together pro forma and those kinds of things on a rental property, to make sure that we know where our loan is going and that we have some comfort in the relationship. And I said relationship a lot because I think for CDFIs, we've sort of become the relationship bankers that banks used to be, and have a lot more difficulty being with their current structures and regulations, for good or for bad. That's kind of the place that we've stepped in to try to do that. So we welcome your questions as far as range of loans. Most of ours are usually over $50,000, and we go up to, we've done loans as high as $5 million. So ours are typically to developers that have fairly high liquidity. If they're nonprofits, they are nonprofits that have been established and are of some size, or they've partnered together with a developer in order to do that. Now, there are other CDFIs, and Jim can talk about what they do, that will do small dollar loans. So there really is no answer to like what any one CDFI will do. But for us, it's those larger, what some would consider larger, but really kind of medium loan sizes, not necessarily large enough that some of the national lenders are willing to step in, but enough that they do make a pretty huge investment in the deal from time to time. And that's what I've got. If anybody has any questions or you want to hold questions.
We do have a quick question in the chat box.
Okay.
Do you consider a duplex multifamily?
Rental, anything rental.
Anything rental
That's
is
a great question. So yes, in the technical term, single family is anything 1 to 4 units, right? I'm talking about rental properties. It's where we specialize, not on home ownership activities.
Great question. All right. Like I said, please continue to drop questions in the chat. We will move to kind of a question and answer panel discussion after we get our next presentation. Jamie, do you want to go ahead and queue up the presentation and give an overview of Spark, and then Lee will jump in to talk about Spark Capital?
Sure. There are a couple of questions in there around interest rates and price points for loans. So I don't know if we want to let Lara respond to that from a MHDF's perspective, or if you'd prefer to wait till the end.
Yeah, so I would say that we are, we typically try not to compete with banks. So we're not going to offer traditional, extremely low rates. We're usually about 250 basis points below what bank lending will do. Usually so it's not going to be more than what you're seeing in the private sector as far as the interest rates and the amortization. We also try to keep any of our loan fees to a minimum. We have a 1% loan origination fee unless it's a perm loan, and then we have what are some legal fees. So our costs are not going to be considerably different. And I would say, just as a general entry point, you don't need to come to us sort of in comparing with banks. Usually most of our referrals are going to come from a bank that is like wanting to provide you, say, with your construction loan, but there's still a gap there. Or they're wanting to work with you on your term loan and your construction loan, but they know that you need some pre-development assistance.
Great. So I'm going to just chat a little bit about what Spark is. And, many of you are familiar with us through the Developer Academy or as a advisor or have participated in these deep dives, but I think it still can be sometimes a bit of a mystery about what all these different organizations are and what their roles are. So I'm going to just go over some information about our organization and then turn it over to Lee to get more specific about what the lending arm of our organization does, which is Spark Capital. So Spark has been around for just about 4.5 years. We really kind of started hitting our stride about 2 years ago. We are really rooted in the idea of holistic community development. So you see these different icons in the circle that represent what that means to us. We often focus in the more physical development space. However, as we build relationships, make investments, and help try to transition or transform some of those physical spaces, we're pulling in these other pieces along the way in an effort to lift up the expertise and leadership of organizations and individuals that already are moving forward in these other areas. So we have values around community, sustainability, and integrity. It's really kind of guides how we select projects, how we work with community partners, how we see our role in neighborhoods. And this is really important to us, not just in the short-term kind of project by project basis, but in the kind of long-term goals that we're trying to see come to fruition in neighborhoods where we're working. So for our organization's operations, but then also in the community. So you've heard the phrase qualified census tracts, or many of the focus of many areas or many organizations is in certain neighborhoods. We work in areas that have kind of a few things that we consider. So one thing is that we want to see that there's strong local leadership in place. We don't want to plop into a community without having those established relationships and community leaders that are already implementing their vision and their goals for their neighborhood. So we really do want to see that leadership. It doesn't have to be through a formalized structure. Neighborhood associations may exist in some areas, they may not in others. They may not be representative of communities in some areas, they may be so in other areas. So a neighborhood association is not necessarily a requirement for our engagement. It's really about engaging with those individuals that know their community, know the vision, know the future, know how to engage others, and have a leadership style that brings others to the table and lifts up their voices too. We do, as it pertains to our loan fund, have a specific focus on what's called the Qualified Census Tracts, QCTs. So those are census tracts across Omaha where there are low and moderate income levels at enough of a proportion of the census tract that it gets that designation. It doesn't mean that all of our projects have to serve low and moderate income individuals, but because they're in those census tracts, the work of our organization will have an impact in that space. Generally, Northeast and Southeast Omaha is where we're focusing, and you can see some of these blue circles generally kind of hovering over the spaces where we have relationships and are either directly working on projects or will be partnering on them or scoping out new opportunities. And then another big layer we look at as related back to our holistic community development focus is where there is transit. We know that connectivity is absolutely vital, both from a community social interactions perspective, but also from an actual being able to get from point A to point B. And so we look at corridors where there is existing transit or future transit planned. And of course, that also includes multimodal transportation options like walking and biking infrastructure. So adding all those layers together and thinking through how holistic development can really pan out is our way of identifying where to work with community partners. This is our team. So you've already met Angela, of course, and have met Lee too. Lee will be speaking here shortly. Many of you already may know or have worked with Manny Cook. He's our urban development manager. And then Mars Johnson joined us just around the same time that Lee did as our strategy intern. And they support us in many ways around our communications work. We'll also be adding on a second part-time intern here in a couple of weeks who will work under Manny in urban development. So at the end of the day, what we're trying to accomplish are these major goals. We want to increase knowledge, and that is often accomplished through this work that we're doing with our technical assistance programming around community development, real estate development, and finance. We want more connectivity within the ecosystem. So that does harken back to our guiding principles of connectivity, both in a social sense, but then also in that physical sense. But within the ecosystem of community development, obviously in the word community, it seems inherent that there should be partnership, but that doesn't always happen if you don't have trust and relationships and engagement. And so we're trying to continue to support that and promote that through our work with engaging with other nonprofits, engaging with community leaders, bringing people together around policy issues, around funding opportunities, and so on. We want to add more resources. So we want resources, both technical resources, financial resources, relationships to come to the table to help improve community development. We want more projects, obviously. We're doing all of this because we want more development to happen that is driven by the community, owned by the community, and is appropriate for the scale and the context and the neighborhoods that they're working in. And at the end of the day, what that results in is expanded investment in neighborhoods. So we have financial investment, human capital. We have just a better quality of life across the board for folks. Another visual to kind of illustrate that. So neighborhoods are at the center of our work, and the partners that we bring to the table include the variety of folks you see around the circle. And we serve in that catalyst, collaborator, project manager, financial partner, technical assistant, and advocacy role. Here's a couple of examples of some planning projects and placemaking efforts we're working on. In South Omaha, we've been working on a park. In North Omaha, we have a trail that is under our umbrella of areas that we're assisting, and then we'll be getting some property into our inventory here shortly that will help us also catalyze business development and more vibrancy and placemaking in the 24th and Lake area. In addition to these, we're also partners on the Canopy South redevelopment initiative in South Omaha. And so that's led by Cesar Garcia, but we're at the table as a partner to think about how implementation will shake out once the redevelopment plan comes together. Obviously, you're familiar with our educational and advocacy programming. The Developer Academy and Deep Dive series is a key piece of our educational programming, but we also provide a lot of one-on-one technical assistance. We just wrapped up an analysis of the community investment trust model that looks at how to utilize property value increase as a way to build wealth in a community that provides that wealth building opportunity to low and moderate income residents in the neighborhood as that neighborhood is changing and potentially gentrifying. So it's a bit detailed and complicated and nuanced to go into. And so we will likely be having a training session, not connected with our deep dives, but with more of our peer learning sessions later this summer to share the results of that analysis and to talk about some projects that are planning to move forward in relation to that. And so if you're interested in that, just make sure you let us know and we'll get you on that invitation list. Talking about peer learning, we've hosted a handful of educational sessions throughout the beginning of this year with our peers in community development, philanthropists, business folks, nonprofits, to just raise awareness and knowledge around these different components of development and finance. We'll have a session next week, actually largely facilitated by Maureen, who you heard from at the beginning, who's going to talk about the American Rescue Plan Act and the funds that will be coming to cities across the country, or that are coming to cities or already in cities, and how we can maximize those dollars and through partnerships with public and private entities. And then, like I said, I already talked about the ongoing one-on-one technical assistance. And then, you know, from an advocacy perspective, we've been engaged at the local and the state level in partnership with other organizations to monitor bills and identify areas where we can potentially put some of our political capital forward to advance change. So we're excited to dip more into that as we go into the future. That is all I have to say at this point. I think what we'll do now is, if Lee is ready, he can jump in and talk about what Spark Capital is, the lending arm of our organization. And I'll drive the slides for you, Lee. Oh, Lee, you're on mute.
Okay. So again, my purpose is to talk to you essentially about Spark Capital, or should I say Spark Loan Fund. Our mission at Spark essentially is to profoundly transform disinvested neighborhoods into healthy, thriving, vibrant communities. And so essentially what I'm talking about here is that our mission is to work within those communities and neighborhoods where developers, builders, as well as perhaps even the city may have stopped spending money to improve neighborhoods, businesses, and shared spaces, as well as those communities that have been historically deprived of access to capital through redlining and other discriminatory practices. At the core of Spark, in Jamie's remarks, she mentioned that Spark is all about convening, collaborating, catalyzing, activating essentially. And Spark does those things because Spark believes in the power of community. We engage, we listen, we seek to understand what the community wants, and then we act. And at the end of the day, that is how this loan fund came about. From past engagement with the community, Spark heard that there was a strong desire for sustainable economic opportunity, expanded housing options, preservation of neighborhood, culture, and people. In other words, the community wanted their neighborhood left intact, healthy, but left intact, improved, but left intact. And so from this leaning in and hearing what the community wants, as I said, Spark Capital was born out of that. And so essentially what we're looking to do is sort of to reverse what has historically been the trend in terms of disinvestment in our neighborhoods and communities by providing investment, by providing capital, so that the community, in this sense, in this case, can invest in itself. Next slide, please. So in doing that, as I said, Spark has formulated a loan fund. And today that loan fund stands at $2.5 million. We have a goal of obtaining $3 million, or having $3 million endowed in this fund by the year end. There's a chance that the loan fund could be pushed upward to $5 million if we are awarded participation in the workforce housing program that was mentioned earlier. Supporting the $2.5 million are monies from philanthropy as well as area banks. I believe altogether there are 6 area banks that are investing in the neighborhood. And these neighborhoods and communities that I'm speaking of are primarily located in, or at least in accordance with our folks in North Omaha and South Omaha. But again, these banks are investing in these neighborhoods through Spark along with philanthropy. And one of the great things about Spark is definitely its spirit of collaboration and reaching out not only to involve the community, but to involve anyone that has the interest in mind or the interest of the community in a holistic way for the community. Next slide, please. So what we finance, essentially, what we finance are housing projects. As I said earlier, the community wants expanded housing options. So we look to finance builders that are doing single family housing. We look to finance or support multifamily housing, and even community facilities that might have a housing component as a part of it. We also look to support economic development activity. And what I mean by that is it could be a mixed use type of project. All of our loans at this point, for the most part, are focused towards real estate development or real estate activity. So it could be financing for a doctor's office, a dentist's office, things like that. From an educational perspective, we look to support charter schools or even daycare facilities, as well as community health and wellness centers. Next slide, please. So basically, in terms of the financing we provide can essentially be broken down into 4 types of lending activity. Pre-development, which would be geared towards pre-development activities, planning, design, engineering, environmental studies. If a member of the community or a developer needs money to sort of get their project going, or if they've already started and maybe something popped up that they were unaware of, or there was a need for them to have a second appraisal done, and they don't quite have the funding or what's needed to cover that, they can come to us and get that kind of support. The loan fund also supports acquisition to purchase property, and in this situation, we will also cover the closing costs. Obviously, construction, new construction and rehabilitation costs are covered, and bridge financing is also supported from the loan fund. Thus far, Spark has, in terms of our pipeline, we have 5 projects that look promising, and actually one of those, perhaps even 2, we're expecting or hoping to get an approval this week, and it will be our first loan activity. Next slide, please. So who do we look to support, or who's eligible to borrow money from Spark? Well, primarily emerging developers, community members residing in the neighborhoods, the communities that Spark work within. Nonprofit and for-profit real estate developers are welcome to apply. Community development corporations, owners and operators of child care centers that might be interested in starting up new or expanding existing operations. Vendors or entities that provide healthy food to grocery stores, or maybe even have their own shop where they're providing healthy food to the community. Those types of facilities are eligible or welcome to apply, as well as health centers and community health centers. Federal health centers and community health centers is certainly welcome, as well as housing authorities and other entities of such. Next slide, please. So in terms of where we work, in terms of activity, Jamie sort of overviewed this earlier, but essentially Spark loan funds are eligible to go to any qualified census tract in Douglas and Sarpy counties. And the census tracts here are denoted in purple. Now, it must be, or I will state, our focus is the census tract in the North and South Omaha community. I mean, we will look and we will provide financing for activities outside of North and South Omaha, but these are the communities that have historically been disinvested in, where we are looking to reverse that trend. And I guess the thought too is Spark certainly can't reverse all the history of the disinvestment, but what we can do through this fund is sort of prime the pump, if you will. And by priming the pump, it will help hopefully serve to attract other investments into the community beyond what we're looking to provide. Next slide, please. So in terms of our contact information, if you should feel so inclined, it is here. You can hit us up on LinkedIn, Twitter, Instagram, Facebook, basically any type of social media outlet that you might have, or you can connect with us. That's all I have for now. Thanks.
Thanks, Lee. We have had a couple questions come in. The first one came into me and it's asking about a car wash space. Would that be seen as a commercial development, and is that something that would be an eligible project type for Spark Capital?
Yeah, it's certainly eligible. It would be seen as a commercial activity. And I assume they're looking to purchase space or purchase an area in order for the washing to occur. So yeah, that's certainly eligible. And then also, the other good thing about that type of activity is a element of job creation, which again kind of goes back to what Spark wants in terms of creating sustainable economic opportunities within the community.
Just can't be one of those automated ones where nobody's there when you drive your car, well, you get it off the track. I do that all the time. Sorry. We also had a question come in the chat box. Tiva, do you want to ask it or do you want me to ask it? I think I can ask it. Does Spark provide financing to multifamily units? Do they have to be low income or can they be market rate units? And she doesn't have access to a microphone. So sorry, Tiva. Lee, okay. Do you want to field that one?
Well, I mean, if it's fulfilling sort of an economic development purpose in a low to moderate income area, it's something that we would consider. So yeah.
I think too, just as it comes back to the mission of our organization and the guiding principles that we focus on, we would also be really eager to see how that, if it was maybe a market rate project, had a mix of incomes. So is there an opportunity to include a portion of them at 60% area to median income, some at maybe, more in the 100 to 120% area median income? I think those are things that we would be willing to talk about.
Great. Please feel free to continue to drop questions into your chat box, but I'm going to kick off kind of a panel discussion with our presenters, asking a few questions, but we will always interject with your questions first.
Angela, I just noticed that Michael Jefferson has asked a question about what are the price point for loans? Oh, mm-hmm. Are you talking about what our loan ranges are on loan amounts? And Michael, could you clarify? Yes. Okay. So Lee, would you like to take that?
You could You can
Okay,
take that one.
so similar to Midwest Housing Development Fund, probably the smallest loan would be about a $50,000 loan. Our largest loan would probably be up to about $400,000 right now. I think it depends on the type of loan that we're talking about too. As our fund gets bigger, we'll be able to provide larger loans, but for now, that's kind of the space that we're in. We also have a 1% loan origination fee. So that would be another fee that's associated. And our interest rate is at this point right now at 7%. And so it is actually quite a bit higher than what banks are at for sure. But that is, we need to shore up a loan loss reserve. And in these early days of putting our fund together, we need to pull that from we need to account for that within the funds that we already have in place. So again, as we're able to raise more funds and get this on more solid ground, I think we'll be able to drop that rate and be a little bit more competitive in that space. But we are filling a gap, so.
Great. Keep those questions coming in. First question for the panelists. We talk a lot about this in the Developer Academy. Timing is everything. How do emerging developers know when is the right time to come to you to talk about financing? What's the right answer to that? A lot of our panelists, from the city to architects and engineers, have highlighted the earlier the better. Is that the same mode and model for communicating with CDFIs?
Yes, it is. I would say whenever you're ready, just come in and see us and talk to us. And from that point, we will sort of perform a assessment of where you are, at least where we think you are. And we will plot a course of steps to take next, in order for you to obtain financing or whatever you might need in order to position yourself for financing. So yeah, the earlier the better.
So before, like in the pre-development phase, to come in and chat with folks before they acquired property.
Yes, I would say early on. I want to say almost at the conceptual stage, so we can help you. I mean, part of what we want to do is work with you, guide you, make sure you're going. I mean, while there's many ways to skin a cat, so to speak, I mean, we kind of want to make sure that you are progressing a certain path. And so, yeah, probably at the conceptual stage is good. Just come in and talk to us and we'll go.
Would you agree for your organization, the earlier the better?
Yes, for sure.
So in addition to CDFIs, what other resources, both nationally and locally, should our developers be tapping into for their projects?
Laura, do you want to take this maybe from a, oh, go ahead, Lee.
I mean, I can go ahead, Laura, and then I'll chime in afterward if need be.
I would say for the developers in the academy, the resources that you should be looking for are more people than money to start out with. It's really about connecting with organizations like Spark, making sure that your housing development model and your product looks strong. And then when you're looking at financing, talking about, I mean, when it comes to it, it's about return. If it's an investor of equity and how you figure out what that can be, or if it's being able to repay a loan, if you're talking about lending, and it's really working with, there's a lot of really, what do I want to say, that people in the community, they're very generous with their time, that will talk with you. There are lenders that'll say, hey, we can't make a loan and we'll do the same thing, but this is what you ought to be looking at. And just like any business startup, you have to look at, if you don't have the capital put in, do you have friends, family, connections that can help you with that initial investment, and how you figure out how they can get a return on that down the road as you get going. So there's no like grant funding that helps people just get some houses built so that it's available in the community. I'm not saying there's no grant funding period, because there are grant resources that can plug in, but it's really about knowing folks that have worked with more and more products and more developers that are going to be able to pinpoint some of those things that you frankly could spend years doing online research and trying to find those sources. So I would point you more to working with others in the community than to looking for funding sources.
Anything to add from this?
And
Oh.
well, honestly, just in terms of financial resources, since a lot of what we're talking about relates to affordable housing, I'd say the Federal Home Loan Bank, there's an affordable housing program, AHP, that is out there. Home funds, CDBG, obviously the low-income housing tax credit program. There's a 4% tax exempt bond program that finances a lot of mixed use or mixed income, if you will, type of housing. There's a housing trust fund. In some states, and I'm not sure if it's available here, but there's a Medicaid waiver program that can provide support. In some cases to senior housing. And there's other programs that provide sort of a housing stipend, if you will, for the individual. Like if someone was providing housing for individuals, say, just sort of graduating from, if you will, like a boys center, sort of 18 to 24 years old, there's funding out there specifically for them. So, I mean, those are some sources, depending on what you want to do, that's available.
Yeah, Lee, I think that's a good point to talk about the difference between subsidy and resources that are attached to the development itself or to the individuals that could potentially inhabit the development. So if you are looking for sources of funding to help make your development a reality, so that's pre-development, that's acquisition funds, it's construction maybe, and then of course your permanent financing. There's sources of funds really focused in that space. But then if you're also thinking, okay, well, the tenants that live in my space, where is their income coming from to support their lease? If you have a good source of conversation would be with the Housing Authority. They have Section 8 is a housing choice voucher program is what it's called now, or it's been called that for a long time. But then with that are other resources. There's another program called the project-based voucher program. So that means instead of the tenant carrying that Section 8 voucher, that voucher is actually tied to the unit. And so the unit then becomes, that becomes a consistent source of income that the developer can depend upon for repayment of debt associated with their development. I see a question in here around what kinds of credit requirements we have for Spark. So we don't have a specific credit score. What we do ask for is the same things that a bank is going to ask you for. We're going to ask for financial statements, tax returns. We're going to want to understand the financial health of your entity. We do not make loans to individuals. We make loans to entities. So it would be an LLC that you would start. It would be whatever your business structure is. And so we're going to want the financials from the business, but then we're also going to want to, depending on how old your business is or the size of your business, financials from you as an individual too. So that again would look like tax returns. We're going to want to see balance sheets and profit and loss statements. If you go to our website, you can see what is requested as part of kind of the first set of documents as part of our loan application. You can go under the financing tab and you'll get sent to a link for a fillable PDF that shows what's all requested. This is pretty standard information that's asked for from your bank. So if you're already working with the bank, you're just take the information and give it to us too. Laura, I don't know if you would suggest additional information that's required by MHDF.
Yep, same for MHDF. Our actual application, if you go to our website, is like 4 or 5 pages long. That might look deceptively simpler than it is. We do like to think it is fairly simple, but it's we're going to ask for all of that financial information that you're talking about. We're really looking at the soundness of the proposal. Do we think there's a market? Do we think that your assumptions based on what you think you're going to be able to charge in rents, what your assumptions are and being able to get construction, it's all an analysis of that component, and then also what we can have as collateral. So are we going to be able to have the real estate? We're going to have a lien on the real estate. And if we have a lien on the real estate, what's it worth compared to the amount that we're lending? And then also your liquidity as a borrower. We look a lot at that. So not only do you have a good track record in repaying any debt you've had as an entity and as an individual. So we're going to look at both the entity and the personal information that we're lending to the entity. And so if you have anybody else that you can bring to the table that's willing to provide a guarantee, sometimes we see that works really well. You may have someone that you're close to that doesn't have cash to help you out with, but they're willing to provide a loan guarantee. So that can help to overcome some of that risk concern that we might have as a lender. And so in the end, we're just looking to make sure we can get repaid, that you have resources to be able to repay the loan.
Two things. One, Lee, we had a comment. It was difficult to hear you when you were listing off some of those resources. So I was wondering if you could drop those in the chat. I think you were talking about CDBG and home, just any of those other resources. If you could drop those in the chat, that would be great. And then I wanted to dig into the application process for just a minute. Just hearing the word application might cause some anxiety. I know this is only 4 pages, Laura. Ours is, I feel, accessible as well, but for new and emerging developers, that can be a real obstacle. Is that something that your organizations are willing to work with folks on, so that they're kind of walking through the process together rather than, you know, submitting it and then just, you know, crossing your fingers? Talk to us about that process.
Do you want me to start?
Go for it.
Okay. For us, frankly, if you're struggling with, like, we're not sure what these terms mean in the application, we're probably going to suggest that you work with an organization like Spark that will help get you to a level where you're more comfortable with that, because you're probably just going to get even more frustrated and lost when you get to the loan documents, for example, and understanding what you're committing to in your loan documents. And then also it can raise some concerns on our end as to your ability to understand the real estate process in the market if you're having any trouble with the actual application form. Now, that said, 99% of our loans, the application form is like one of the last things we do before we're ready to make a loan. And we will actually complete a good portion of the actual form itself. It's all of that other information we've been having conversationally. So show me what your performance is. Where are you building at? Where's your lot? Who's building it? Those kind of things. We will have talked through all of that before you've put an application together and submitted it. So we have had folks that are like, do we need to get you the application? And we're like, you already did. You just didn't like realize it because it was in all of these other discussions and conversations we were having all along as we were working on the development.
So to kind of add on to Laura's point of the level of assistance that we'll provide at Spark, I think, you know, when Lee suggested to reach out to us as early as possible with your project is a great idea, in that also helps us assess your capacity and readiness. And, you know, we've all met folks that are really, really strong in ideation and have great ideas and vision, but the practical process of putting together a project requires oftentimes a different set of skills. And so we could suggest from an early conversation, like Laura said, let's talk about what a partnership could look like between you and someone that maybe doesn't have necessarily that strong vision or strong ideation, but really gets the practical elements of this. That could be a really good partnership to put together. Or if there's an aptitude and a capacity to build those skill sets, we're going to recommend come to our Developer Academy or apply to the Developer Academy, join the deep dives. You know, outside of what we provide at Spark, there's no shortage of resources. There's a certification program if you don't want to go through the whole 4-year undergrad degree at UNO. They have a 15 credit certification program in real estate that could be very valuable. Urban Land Institute is a national entity, actually international entity, that provides a lot of capacity building. NeighborWorks, they have training that they provide at the national level that is fantastic. Obviously, our partners with the National Development Council, you can take courses from them. I think probably one of the advantages of our programming is that we are often a free or very affordable service, but it is still very high quality. And so that may be more of the carrot to engage in our programming. Just as an example, and maybe just to help you as you're thinking about dipping your toe, or if you're already in this space and are thinking, okay, this is intimidating and an overwhelming arena for me. You know, the borrower that we're going to be working with, or that we are working with now, is an individual that we started a conversation with about 5 years ago. So to Laura's point of, you know, oftentimes it's 2 or 3 years before a loan's actually made. It's about cultivating and building that relationship, and oftentimes between us having the hard conversations of you're not ready, or we're not ready, or you're missing this, you need to work harder in building out your model here, or this isn't going to cash flow, is this the right thing to do? You know, having those tough conversations, that doesn't happen with one meeting. That happens over time when you build that trust and engagement with each other. So as you're thinking about that, don't let that longer horizon diminish your hope that things aren't possible. It's just there's a lot of risk and a lot of reward that's associated with this work. So Tiba's asking a question around, may I provide a list of those organizations? I'm sorry, what organizations was I referring to?
She's talking about the ones that also provide real estate development finance.
Oh, sure. Yep, I'll drop some. I'll just throw them in the chat, some of the ideas that I threw out there.
That's great. And we can also, we'll put these links and the resources that Lee had mentioned before in the follow-up email that will come to you, hopefully at the end of the day, with the link to this recording. The next question, I think it kind of goes back to what Jamie was talking about, maybe with that one example, and maybe Laura, you have others. I know you have to jump to another meeting soon, but what are those common stumbling blocks or obstacles that you see facing our new and emerging developers? So like in that example that you gave, Jamie, you said it was like 2 to 3 year process. What were some of the obstacles that you worked together to overcome?
I think that the obstacle that is more difficult to overcome and is exactly what I was talking about in how strong the developer's personal balance sheet is, and being able to bring in a partner or something to help through that. Then after that, let's say it's somebody who comes to the table with resources, and there are many people that do. They've been running another business, they've decided to get into real estate, and they have that ability to do so. Then I think it is being able to, the biggest stumbling block is being able to really sit down and be realistic about what construction costs are going to be, what operating expenses are going to be, and what kind of income there's going to be in the property, and what kind of returns that there are. There are developers who come to the table who want to help their community and say there's money to be made in real estate, and I want to do it this way, and it most definitely can be done, but it is not necessarily going to bring as much actual income in on the first few properties as people would like. We hear this all the time when people are like flipping houses or whatever your examples are. I really just think that's the biggest stumbling block, is to be able to get to where telling the story is speaks to maybe the devil's advocate. Like if you're telling somebody, this is what I'm building, this is who's going to live there, this is the kind of what's going to cost me, and this is what people that live there are going to be able to pay. How do we be able to answer those questions with someone that's saying, what about this? What about this? What about this? And being able to answer that and have answers for it and responses that make sense, and understanding that you're putting some of your own equity into the deal. And so that will go a long way and be able to show you're willing to take that risk too. I'd say that's the other thing, is when folks aren't willing to put their own equity in and they're looking for other sources to pay for it, it just raises a lot of red flags as an outside, as a lender. I don't control exactly what you're going to do. I can say, this is what we agree between the two of us, but I don't know how you treat your contractors, for example, or I don't know how you're going to really, how much luck you're going to have in marketing to your tenants when you start filling up units. So I'm leaving a lot to you. And so it helps a lot if you have your own equity. So I kind of went around on a lot of things there, but it has a lot to do with just approach of understanding the deal.
Jamie or Lee, did you have anything to add to that?
So I don't know if patience is the right word too with that. I mean, I probably am saying it just as much to myself as I am to other folks that, yeah, if you've got that strong vision and idea, the time and energy it takes to put a deal together requires patience and focus. So if in some conversations, I understand folks are raring to go and excited, but then to take a step back and say, okay, what do I need to do to get to the next step? And then not letting stumbling blocks dismay you and dishearten you.
Yeah, to know that it's something to anticipate and expect.
Again, saying that just as much to myself as I am.
Right? All right, we did have a question come in through the chat. What percentage of equity is normally expected, are you normally expected to put in for a single family or multifamily development? Is there a standard, or what are you looking to see?
So your very basic standard, your rule of thumb is 20%. Now that's what a lender's going to look for. We don't necessarily come at it that way in our properties. And a lot of that's because we're working in the low income housing tax credit program. So equity is coming from someone besides the developer. I would say for us, it's not so much a matter of a percentage of the development costs. It's a showing compared to what you're able to put into the project and your ability to sort of back up the loan in some way, whether that's a loan guarantee or whatever the case might be. I mean, we're partially there so that we can help with things that you don't necessarily have all that cash up front. I mean, we work with nonprofits that are going to do some fundraising, but they don't have a lot to like purchase the property right now. So we aren't, a bank though is going to pretty much ask for a 20% equity component, whether it's from you or for someone else. But we do not have a percentage as a baseline.
And Laura, would you also say to that, and then Lee, kind of from our recent experience, that's why it's also really important as you're building out your development budget that you're accounting for all the costs, things that you did on the side and then you forgot about. You need to make sure you're capturing the true value of that and including it on your development budget. Anything that you're getting in kind maybe, or something, I don't know what that may look like, but just making sure that all the development costs are accounted for, because you may find that you're actually 50% in a deal.
Right. So you also want to keep track of the cash you're putting in. And I'm talking about the $20 you paid to, get these forms from the county or whatever the case might be, what you've spent there. You may want to separately track some of these other things, your time, your any in-kind resources. Now, a bank isn't going to see that as your equity that you put in, but we as a lender acknowledge that it's going to take some of those things to bring it together, and so that time you've spent is there. So on that topic, I also want to add that I've seen sometimes, don't forget to pay yourselves a developer fee. I've seen a lot of folks are like, well, I just want to get the rental income. So I'm not concerned about the fee for getting the development. But the issue is we need that because that's a contingency for us. That's if you came in under cost or something or over costs, then you're going to reduce, you're going to what we call defer that developer fee for a while. You're going to get it out of the income from the property. But it only makes sense. Otherwise, it's kind of like from a business perspective, we don't know you have as much sort of in it, although that's technically what you take out of it on that developer fee. So make sure that you include some kind of developer fee. And if you have anybody who's providing financing, sometimes it'll come from philanthropy or others that have a concern about that, like, oh, what's this fee in there? What's it for? There's a lot of resources out there that can show it's an industry standard and it's really a best practice to make sure you have it built in. Now, how much should it be? I say at least 5%. Some are closer to 8% and as high as 15%. It just depends on the deal and the kind of financing. And what I mean by that is, say it costs you $1 million to do this project, the hard cost of construction, make sure you have 5, 10, 15% on top of that that comes out that as part of your project cost for the developer fee in the deal. Does it mean you're going to get all of that? Maybe, maybe not. Depends on how your costs are going to come in, depends on how your income comes in. But that's really important to someone who's providing a loan in the deal.
Thanks for that, Laura. I just wanted to echo that, make sure that all of your costs are on that total project costs. Through the Developer Academy, I saw several capstone projects early on where they were, the people already owned the land, and so they didn't want to put the value of the land in. That's already cash you've spent, and that shows your skin in the game, so to speak, for the project. So make sure that all of those costs are in your budget.
Plus that's collateral you can potentially offer to anybody who's lending to you.
Yep.
And just allow me to add too. I mean, if you think forward in terms of the next project, where you want to kind of look back to see what you did previously. And so if you didn't account for all your costs, you're budgeting, or there's a very big chance that when you budget your next project, you're going to omit some of the costs.
Yeah, if you're using it as a template for your next project, that's a great point, Lee. Okay, I had a couple more questions, and then we can wrap early if there's nothing else from our participants. The next question is, what is the traditional relationship between a lending source like a bank, or a traditional lending source like a bank, and a CDFI? And how can CDFIs help developers establish those relationships? Or is that not something that is done with your CDFI?
I think for us, it's probably happens more the other way around. The bank helps us establish the relationship with the borrower because there are gaps in the financing that the bank is not able to fulfill, but they want to overall invest in the project. That said, sometimes it does go the other way. We're working with somebody and we usually at a pre-development lending stage because they've come in for some technical assistance in a pre-development loan. And then we'll start linking them up with potential banks and lenders, say they're looking for construction loan or something. And we are familiar with, banks have something called their CRA requirements that they have to invest in certain areas and different types of ways they do that, loans or equity. We have some familiarity with individual banks as to what they're working with in that arena. So sometimes we can make a linkage that wouldn't have kind of more organically occurred. Maybe it's a bank from, I just sent a note to somebody in North Platte for a bank from Springfield, Missouri that might actually be a good option for them. So sometimes it's just not somebody you would even know to reach out to, and they wouldn't know what you're working on too. But I would say we get most of our connections through the banks themselves if it's not through our LIHTC, our tax credit developers and that investors.
Our relationship with banks, maybe backing it up even before we're doing the lending, is to get their investment in us. And so we, as Lee shared, have foundations, we have banks, we had some of our own equity that we put into our loan fund. And the way that the banks invest in us is partially through their obligations associated with the Community Reinvestment Act, in some cases largely because of that, and others because just the bank has a social impact focus or have social impact goals that they're trying to achieve through our investing. What we've found when we've reached out to banks, especially our local banks, is there's also I think a good camaraderie amongst the banks where they see other banks investing. And so then they want to be a part of that community giving and that initiative. So when they invest in us, though, they're not giving us money for free. They're investing at an interest rate. And so we have banks investing in us anywhere between 1 year and 10 years, as low as 2% interest up to 2.5% interest. And we have obligations to them to report out on our loan portfolio, our performance. you as applicants, and the profile of your projects and what you're working on, because that helps them make sure that they're in compliance on their end with the CRA and their investment goals. Same with the foundations. While they don't charge us an interest rate, at least the kind of investment we get from them, we don't get charged an interest rate. We also have reporting, more social impact reporting that's due to them.
And I don't know if it happens for you, Jamie. I know for us, say you're talking about Wells Fargo Bank, in which we have as an investor in our loan fund. Who we work with in order to get that investment is a completely different person than we would connect you with if it was providing a loan. So there is these different touch points we have with banks, but it's not always the same person in any scenario. And if you're doing a rental property, you're going to work with the commercial real estate lender versus if you're doing a single family property, that's for sale. You're going to be working with different people at the bank. So that's just another thing to keep in mind when you're working with banks. If you have a specific lender relationship, that's great, but you may need them to connect to other people within their own organization. And as Jamie said, Omaha really does have a good network of lenders that talk to each other too, and kind of see where are those opportunities depending on the type of loan and the type of project that's there. But we do have because we work in lots of other communities, you do really have a great lender base here to work with as far as seeking loans. Most are very friendly to at least coming in and sitting down and talking to you about your project. And they want to try to find ways that they can bring you into their bank. And so, and even if we're your lender, we like to call it you're nearly bankable, right? So that's who we're working with. We're trying to get you there so that your next deal, you might not need us anymore unless it's, a very specialized kind of lending opportunity. So we work in that kind of area too. So the banks see that as well. If you can't borrow from them today, you may be able to build up your portfolio enough you can borrow from them in a year or two.
Great. The last question I have, I'll ask, and if there aren't any others, then we can end a little bit early. I am going to drop in the chat box a link to the satisfaction survey. I know I send this out in emails. I really want to encourage you just to take 2 minutes to fill it out. It helps us show all of our amazing sponsors the value of this type of programming. So please take just a couple minutes to fill that out. All right, so the last question I have, Laura helped me reframe this one because I was coming from a negative space. So what additional kinds of CDFI services or products do you see us needing in Omaha? Or is it just a matter of volume? I spend so much time comparing us to other markets where there are so many CDFIs. What are your thoughts on what Omaha still needs?
Well, so we created Spark because we saw an opportunity to fill a gap. I think I will advocate that we need more capital in our fund so that we can provide larger loans and longer term loans. Our small business lender with the Nebraska Enterprise Fund provides a pretty holistic set of services along with ranges of loans. So I don't feel super equipped to talk about the small business lending space. On the real estate side of things, I feel like us coming in and helping fill this gap is fantastic. I think that the work that MHDF and MEG do is integral and vital to the affordable housing development pipeline in our community. Any major affordable housing development you see, MEG's likely had a role in it, in nearly all of them, Laura, wouldn't you say? I don't know if that's a fair assessment.
Not all, but many, yes.
Many, yeah. So, I agree. Like, it's not always about needing more, 20 or 30 of something. It could just be filling a gap here or there. Laura, what kind of insight might you have on that? And Lee, maybe any from the communities that you've worked in before Omaha?
Yeah, I am thinking, as I was thinking through different kinds of things that CDFIs do, what we don't have that CDFIs can do in the community that I'm aware of, though I think Spark's possibilities are, really pretty broad because you're just starting. So you may jump into there. But when we get to housing is equity, actually getting in and becoming an owner with you in a deal, and getting some equity return. So that they're actually, the CDFI can be that partner in that role. And then also loan guarantees. So again, another, like, you have a really great model for a new project to develop. You just don't personally, as an individual, have all of that background and capital and liquidity I talked about. I think those are a couple of things that CDFIs could help out in that space, potentially in the community. And of course, we are cautious about stepping outside of low-income housing tax credit rentals, but we will look at other rental properties that are for our mission and purpose. We're not so much geographically focused. We still want to make sure we're primarily serving individuals that are at 80% of the area median income or less. So we're not going to be going great guns into any kind of market rate rentals, but I absolutely think the community needs them. So that would be another CDFI comment, that there's some non-income restricted, but still affordable cost to the beneficiary, the tenant or the buyer, where there's some lending needs to fill in some of these gaps.
Well, I guess I would agree with all of that. I'd say one thing in terms of community marketing, making sure that the community know we exist and how to get in touch with us. Just that maybe we can reach a little bit further into the community that way. But I think I think the CDFI market is, I think we have the reach.
I do, and I just kind of back to what Jamie was saying. I think we have to collectively as CDFIs, and I think we are collectively as CDFIs, others in the community too, just keep pushing our investors, our banks, philanthropy, whoever it is, to understand that we have to have as low cost of capital as possible, because while, you know, Spark has that 2% loan from that, if they don't have that lent back out to somebody else, it's still costing Spark that 2% interest. And so there's always managing that cash flow. So allowing some what we call kind of line of credit, which we have a couple with banks. So we're only borrowing when we need it, allowing that to happen. And then also longer terms. So I can't offer you, I'd love to offer you a 30-year mortgage on that rental property. I think it's going to work out great. I can't, because my capital only goes out 10 years or 15 years, or, you know, what I'm using to fund that loan. So I do think there's some room on the investor side to start thinking about those things and understanding how you really could step up into the next product that really helps all of you as developers to be able to get units built.
And Laura, I'd say that'd be an area where just as some communication to you as developers and emerging developers, that's an advocacy role that we play. So we're fortunate to have these relationships with the financial institutions and with the donors to get them thinking more creatively about how they make loans, and to also go to bat for you as emerging developers and existing established developers, to invest in us so that we can invest in you. So we are working on your behalf.
Great. Well, thank you all for your time. Thanks, Jamie. Thanks, Laura. Thanks, Lee. I saw that Maureen had to drop off the call, but we're thanking her virtually. Please take a moment to fill out the survey. Let us know what you thought of this. If you have any questions, feel free to reach out to any of us. I'll be sending up a roundup email with the link to the recording of this, as well as some of the resources that were shared here today. Thank you all for your time. Hope to see you at the next deep dive in a couple weeks.